Professor Stockamp here. We're going to pick up our discussion of long-term asset accounting with use. So we start with acquisition, what we do when we purchase the asset and initially record it on our books. And then we start using the asset. And when we use the asset, we have two things to deal with. We have repairs and maintenance, which we discussed in the last video, how we accounted for that, which if we have ordinary repairs and maintenance, we simply expense it. If we have extraordinary repairs and maintenance, that's a different story. We may get to that later. But we have repairs and maintenance. And the second thing we have to do is we have to record depreciation. Now, why do we record depreciation? Depreciation is all about cost allocation. So here we have our forklift. And if we assume that this forklift is going to help us in our business generate revenue from 2025 to 2029, or 5 years of time, then we have to expense this long-term asset in such a way that we match the expense of this long-term asset to the periods in which it helps us to generate revenue. So we would have to have an expense amount in 2025, 26, 27, 28, 29, so that we have appropriate matching of revenues and expenses. So if my asset, this forklift, helps me generate revenue over the next 5 years, then I have to expense it over the next 5 years. So number one, cost allocation. I am allocating or distributing the cost of my forklift across the periods it helps me generate revenue. I am not trying to determine the value of the forklift when I'm doing depreciation. Again, depreciation, the use of the term depreciation, when we talk about cars losing value or computers losing value or things like that, that is an okay use of the term depreciation. But when we talk about depreciation in accounting, we are talking about cost allocation. We're not talking about valuation. So we are determining the book value of the forklift in this process. We are not determining the market value of the forklift by doing this process. And thirdly, how do we do it? Well, again, there are multiple ways to do this. So we're going to look at those ways shortly. When it comes to calculating depreciation, we have multiple ways to do this. We're going to take a look at 3 ways of doing this. But there are more than 3 ways. So we are going to look at what is called straight line depreciation. We are going to look at what is called units of production. And we are going to look at double declining balance. So, straight line, units of production, and double declining balance. Now, in order to do any one of these 3, we have to know 3 things. We have to know the cost of the asset, the estimated residual value of the asset, and the estimated useful life. We determined the cost of the asset in our video on acquisition. The cost of the forklift is $16,700. The estimated residual value is what we think the asset will be worth when we are done with it. And then the estimated useful life is the time period we think we will benefit from this asset. And that can be in years or in other ways, like hours or miles or other things. So, we're going to start by looking at straight line depreciation. In order for us to do this and to compare, we're going to create a table here. The table is going to be for 2025, 2026, 2027, 2028, and 2029. These are the 5 years that we are using the asset. Scroll down a little ways and record some area here for our journal entries. Well, we maybe do that later. Save some space for now. So we're going to look at straight line depreciation first. I'm going to try and do these in different colors. The straight line method. The straight line method is the easiest one. You calculate depreciation expense under the straight line method. And you do so by taking the cost of the asset, subtracting the residual value of the asset, and dividing it by the useful life. So in our case, the cost of the asset is $16,700. The residual value is $1,700. And the useful life is 5 years. And so we're going to get a dollar amount per year that we will record as depreciation. And if we do the math, we should get $3,000 a year. So what am I going to record in year 1? I'm going to record $3,000 of depreciation. In year 2, $3,000. And year 3, $3,000. Every year is going to be the same. So I would make my journal entry. Right? What is the journal entry we record for depreciation? We record... This pen is not working real well right for me now. We record depreciation expense, whatever the value is, right? And a credit to accumulated depreciation for the same value. That is the journal entry that we're going to record when we do depreciation entries. Now, it doesn't matter what method I'm using. That's going to be my entry. The methods are simply going to give me different numbers. Okay? So the straight line method, what am I going to have? 2025, 3,000. 2026, 3,000. 2027, 3,000. And so on. So in total, how much have I depreciated? $15,000. So when I finish with my depreciation for the straight line method, what is my balance sheet going to look like? Well, once I finish my depreciation for straight line, my balance sheet will look like this. I'm going to have equipment with a value of $16,700. That's not going to change. I recorded equipment as $16,700 when I acquired the asset. Then I'm going to take out my accumulated depreciation, which at the end in total is $15,000. And then I have equipment net of my depreciation of $1,700 when I am done. Right? I've depreciated or expensed all of the cost of my asset, except for the amount I think it's worth at the end, which again is the residual value. This number also is my book value for the asset, the value on my books. So $1,700 is my book value when I would be done, right? So that's a straight line method. It's fairly easy. You do one calculation and you have your yearly amount. Now, if you wanted to do it monthly, right, what would we do? We would take 5 years times 12 months and we would do the monthly amount, record it each month. You could do it quarterly, right? Figure out how many quarters are in 5 years and record that amount each quarter every 3 months. But that's the straight line method. Now, the units of production method is a little bit different. The units of production method says, all right, well, I want to record the same amount of depreciation for every unit or mile or hour that my machine runs. And so we actually calculate a depreciation rate by taking cost minus residual value divided by the estimated productive life. So a little bit different than the straight line method. And so in our case, cost is $16,700. The residual value again is $1,700. So that's $15,000. And we expect that this forklift will run for 12,000 hours. And so we get a dollar amount per hour. So in this case, we get $1.25. Now, that's not the amount I'm going to expense each year. Right? It's not even the amount I'm going to expense the first year. This is my depreciation rate. Now, in order to find my depreciation expense, I have to take my rate times my usage. So, what do we do here? In order for me to do this, ooh, that was not very straight. Let's try that again. Better. So in order for me to do this, I have to know my usage. So we're going to create a table here. And let's just say that our usage was 3,000 hours in the first year, 3,600 hours in the second year, 3,000 hours in the third year, 1,800 hours in the fourth year, and 600 hours in the fifth year. So we got a total of 12,000 hours. Now, you're not going to know these ahead of time, but this is going to demonstrate how the method works. So in the first year, I use the forklift for 3,000 hours. My rate per hour for depreciation or expensing the equipment is $1.25 per hour, and so I'm going to record $3,750 in depreciation expense. In the second year, I'm going to take my 3,600 hours times the 125, and I'm going to get 4,500. In the third year, again 3,000, so I've got 3,750. In the fourth year, 1,800 hours, and so I'm going to record 2,250. And then in the last year, 600 hours, and so I'm going to record $750. And so if we go up to our table here, under units of production, what's it look like? Well, 3,750, then 4,500, and then 3,750, 2,250, and 750. And if we do all of that, then we get a total of 15,000. So both methods are going to get me to the same place in the end. They just get me there differently. And if I look at my balance sheet after all of this, what does my balance sheet look like? Well, again, I'm going to have my equipment on my balance sheet at 16,700, which is the original cost. I'm going to subtract my accumulated depreciation, which by the end, right, is going to be 15,000. And then my equipment net of my depreciation is going to be 1,700, which again is equal to my residual value and is my book value. Right, the value in my book. So both methods get me to the same place. They just get me there in a different way. What's the benefit to straight line? Well, it's simple and easy to do. What's the benefit to units of production? Well, it actually provides better matching, because in periods where I use the asset more, theoretically, I've generated, or it has helped me generate more revenue. In periods where I've used it less, it's helped me generate less revenue. And so to match the expense to the revenues, in periods with more revenue should have more expense. Periods with less revenue should have less expense. So it provides a better matching. Those two methods are fairly similar in that they start in the same way, taking our cost and subtracting our residual value. The third method is quite a bit different. The third method is double declining. The declining balance methods are what are called accelerated methods. Okay, which means we're going to accelerate the expensing of the equipment. So to do double declining, I like to set up a table. Okay, so double declining requires that we do something before we start our table. In the double declining balance method, we have to calculate the double declining rate. The double declining rate is the straight line rate times 2. Doubling, right, means to multiply times 2. So how do we do that? Well, what is the straight line rate? The straight line rate is 1 over the useful life. And so in our case, 1 over 5 times 2. 1 divided by 5 is 20%. 20% is our straight line rate. Over 5 years, 20% per year gets you to 100%. But the double declining method requires us to double this. And so our rate is going to be 40%. So that's essentially what we're doing, but there's an easier way to calculate this. The double declining rate is 2 over the useful life. And so we would simply take 2 over 5, which is 40%. A little bit faster way to get there. Now, where are we going to use this rate? Well, that's what we're going to build the table for. So I'm going to scroll way down here, and we're going to start our table at the bottom. Now, this table is kind of big. We don't have to make the table. It's not a requirement, but it makes it easier to do. So our first column is going to be for the years. Well, we know this is 2025, 2026, 2027, 2028, and 2029. The next column is simply for the cost of the asset. Well, we already know that too. 16.7. 16.7 all the way down. It is not going to change, right, from one year to the next. And so we can fill it all out. Then we're going to put a column in here that is for accumulated depreciation at the beginning of that year. So what is an accumulated depreciation at the beginning of the year? Well, to start with, it's 0, right? Beginning of year 1, it's 0. Cost minus our accumulated depreciation tells us what our book value is at the beginning of the year. So in our case, 16.7 for year 1. So we don't really need the whole table, but we need this book value at the beginning of the year. That's important. And in order to keep track of it as it's going to change, the table is helpful. We're going to take that book value at the beginning of the year times our double declining rate, which is 40%. That is what tells us our depreciation expense for the year. So in this first example, we get $6,680. Then I want to know, well, what is my book value at the end of the year? If my depreciation, not book value quite yet. What is my accumulated depreciation at the end of the year? Well, I've accumulated $6,680 of accumulated depreciation for the first year. And so my book value at the end of the year, right? What is my book value at the end of the year? If my cost, right? Let me do this. If my cost is 16.7, it's A. My cost 16.7 and my accumulated depreciation at the end of the year is 66.80, then what is my book value at the end of the year? A minus C. Well, my book value at the end of the year is 10,020. So, if I can do one line of this table, the rest are very easy. It's repetitive. What's my accumulated depreciation at the beginning of the year? Well, 10,020. Sorry. Read the wrong column. Book value at the end of the year, the beginning of year 2, is what I finished year 1 with, 6,680. So my book value to start year 2 is what I finish year 1 with. And then I take that times 40%. So I'm going to get depreciation expense of $4,008. How much have I accumulated in depreciation then? Well, 10,688. And my book value at the end of the year is 6,012. 16.7 minus 10,688. So then I come back and I say, all right, well, my accumulated depreciation at the end was 10,688 and my book value was 6,012. And so I'm going to take that times 40%, which is 2,405. And I've accumulated $13,093 in accumulated depreciation, which leaves me with a book value of $3,607. What's my accumulated depreciation when I start year 4? Well, 13,093. My book value is 3,607. So I take that times 40%. And I get $1,443. Adding that to what I have accumulated before, now I've accumulated $14,536. My book value then is $2,164. And the last year, I've accumulated a total of $14,536. When I start the last year, my book value is $2,164. If I take that times 40%, I get $866, which means I've accumulated a total of $15,401 in depreciation, which leaves me with a book value of $12.99. But I have a problem. My problem is that my ending book value, like the other methods, is supposed to equal my residual value, and here it does not. As we see here, right? My book value at the end, $1,700. That was my residual value. Up here with straight line, book value at the end, $1,700. Right? Equal to my residual value. This method didn't get me there. Why didn't it get me there? Well, because I didn't take the residual out to begin with. And so I've got to figure it in here in this last year. So I can't expense this amount because it's not going to get me where I need to go. What do? Well, my book value currently, when I start this last year, is $2,164. I know I need to finish year 5 with a book value of $1,700. And so I can only expense an amount that will get me there, $464. So if I expense $464 in the last year, I will have expensed $15,000 of depreciation, and I will have a book value of $1,700 at the end, which is equal to my residual value. So in double declining, we often have to plug the last expense figure, making it work out the way we need it to. But let's take a look then at our expenses across the years. For double declining, what's it look like? Well, for theirs, it was $66.80, way more than the other two. And then 4008, $24.05, and then $14.43, and $4.64, which again got me to $15,000. Again, the $15,000 is the amount that I am going to depreciate. It is what is called the depreciable base. So, the depreciable base for our asset This pen really does not like me today. So, the depreciable base is equal to cost minus residual value. In our case, the $16,700 minus the $1,700, or $15,000. That's the amount of the cost of the asset that is going to be expensed. And as we see here, it does not matter which method we use. They all get us to a total expense of $15,000 over those 5 years. They just do so in a much different way. What do we see with straight line? Straight line is the same every single year. Units of production is based upon usage, how much we use the asset and how much of its useful life in terms of hours or miles it uses up. And then double declining is an accelerated method that looks at the asset and expenses more upfront and less every year as the years go by. This method isn't often used, but is typically used for tax purposes. So, 3 methods of calculating depreciation: straight line, units of production, and double declining balance.